this was a pretty exciting week. We saw some rate cuts coming out of Canada and Europe, cutting 25 basis points, both of them. And it really looks like the market is taking it and running with it, just like we expected it to happen. I've been even seeing realtors already starting to froth at the mouth now that they're seeing some rate cuts. I think this actually has a lot bigger of an impact than it would in the States, just because variable rate mortgages are so popular in Canada. People like always get 5-year variable rates. So as soon as they start, like this rate hike cycle just completely screwed over all of those people. So as soon as they start seeing some cuts, they're getting really antsy and excited that hopefully we'll go back to low rates again. But we're really not going to get there until a recession actually happens, and if there's a reason for them to do it with unemployment rising. But unemployment is actually still fairly low in Canada, so I don't think that's going to be happening, but I am seeing realtors already start to get excited about it. I think, I don't know if it'll cause another buying frenzy like we had just after COVID during the whole zero rate environment. But who knows? I mean, in Canada, especially British Columbia, Vancouver, like everyone's buying real estate all the time. And so I think now that rate cuts are here, people are going to start hopping back into real estate.
Yeah, I'm sure. And I guess that's the big conversation everyone's been waiting to have, right? So house prices haven't really gotten hurt this cycle the same way that they normally would in a higher interest rate environment, right? Like well, I should say in a real recessionary environment where rates go up, stagflation, right? The house prices have instead steadily continued to climb higher, at least here in the States. I think it's probably the same for Canada as well, right?
Yeah, more or less. It's kind of been sideways. Some areas price has been slowly climbing. Some areas it did come down a bit. I know like Vancouver and Toronto, like they pulled back a little bit, but really not much. Like nothing significant happened.
Right. And I guess when I say going up, I don't mean like, post-COVID style ramp. I'm talking like the gradual like 4 to 5% increase per year type of thing, where they're not really going down. Everyone was looking
Yeah.
for pretty much a housing crush with these higher rates. And that hasn't really happened. And I guess a great answer for that is the supply constraints that we have in America, right? Everyone, like the home builders are there's like a shortage of new homes, right? And I know that's a bigger problem in Canada from my understanding, right?
Yeah. Well, I think also I don't quote me on this. This is just kind of rumors that I've heard, but construction was slowing because they weren't expecting it to be profitable with these higher rates.
Right.
So
Okay.
development
Yeah.
slowed as well, which just contributes even more to that supply constraint.
Right. And that's something that, again, will help almost buoy out the offset some of the negative impacts of higher rates, at least in the short term, right?
Yeah.
So
I mean,
I think that,
I was kind of shocked too to not see much of a pullback in real estate, especially because variable rates are so common here. And I personally know multiple people that got screwed over big time during this hiking cycle, and their mortgage just skyrocketed. And I'm surprised that all the people that ran into those issues, they weren't forced to sell.
well, could it also be that post-COVID, people were able to lock into some, or this might be somewhat of a tailwind at the moment, right? It's not so much a headwind where if COVID was in 2020, right, and then you have 2021, rates are low, you do the 5-year lock then. That leaves like the unlock and re-rate higher in 2026, right?
Yeah, that's for people that get fixed rates though. So variable rates, you're at the mercy of that of rates changing whenever they change.
Right, but isn't there a fixed period, or is there not a fixed period in your rates?
Yeah, you can lock into like a 5-year
Right.
variable. So basically you can't change your rate to a fixed rate because you're locked in for 5 years at a variable rate. That's what that means.
Right.
So you're still getting screwed if you have that variable rate, and you have to pay a penalty if you want to exit that and get a fixed rate instead to stop the bleeding. Which
Right.
I don't think anyone does that. At least
But
I don't know if anyone.
do you think maybe some of this real estate pressure outside of supply constraints in Canada could have been offset by possibly those that stepped into a mortgage in 2021 and did the 5 year locked rate, a 5 year variable, or a variable rate mortgage with a 5 year locked up the rate, at least right now, being able to withstand
Oh
some
yeah,
pain.
for sure. I think if they kept these rates at these levels for longer, maybe another year or two, I think we would definitely start seeing the pain in real estate and actually start seeing prices come down. But yeah, there are plenty of people that are locked in with a rate for 5 years, and they don't get affected at all until after those 5 years is up.
Right.
So
That's a little bit different though than the States, right? Because in the States um, we have 30-year fixed, so your rate's your rate for the life of the loan. So I think a lot of the entire mortgage sector getting turned out, or in this aftermath of what the low rate environment was from COVID. I think that definitely helped in some of the financial burden of housing costs, and then again the supply shortage with rates that low pretty much trickled down to an overall shortage of homes, which I think we're slowly starting to see come back into balance. I mean, to say housing is super strong, I want to reiterate, I don't think that's what either of us are saying. It's just the dynamics in the housing market are way more have been way more robust than pretty much anyone thought they would be coming into this cycle. And I think that even though they're getting softer slowly, they're still stronger than I think if you were to ask anyone right after the Fed, breached 200 basis points, or in the BOC breaching like the 2% mark, right? Like on either side, and the rates were expected to just keep going higher out and blowing out expectations. I think everyone was like, okay, housing is going to be the first thing to go. And I
yeah,
think the fact that it's been so resilient is quite astounding. And I think it's just one of the remarkable things of this cycle at this point that you can just look at and say, like, it's unique to the cycle, right? Like in terms of having an inflationary crisis where you have an extreme level of hawkishness, and you don't actually get a recession. Therefore, housing can hold somewhat of a bid, and housing continues to inflate, but there is no real like economic slowdown to the point where you're going to experience housing disinflation, right? It's going to just inflate at a slower rate, but it's not going to really collapse. And I think
yeah,
that that's pretty much what we've been feeling so far. And I think that that's really what stage 3 of the compound landing is, right? So we can normalize the economy out with these higher rates, but eventually, like we were just saying about Canada, rates have to come down, at least in Canada. I mean, in the States, they should too. I think the Fed is, as of right now, they're pretty much one of the only, or I should say, they're most restricted out of the major economies in terms of forwards, right? So I think that they need to bring rates down, and we'll talk a little bit about that upcoming FOMC meeting next week in a few minutes. But I do think that we're in a situation where if they don't bring rates down, you end up really blowing past that stop sign for whatever type of landing. Some people don't like to call it a soft landing because there actually isn't a recession, or I shouldn't say there's not a material economic slowdown. That's neither here or there. However you want to classify it, there is a pivot out of what would be expected to be a hard landing at the moment, and we pretty much skipped a recession at this point. And I think that that's what stage 3 is supposed to bake into the markets. Everyone's supposed to feel like there is no recession ever in the short period, right? In the short term, like the idea that a recession is never going to happen again, that's nonsense, right? We all know that that's just part of the economic cycle, but the recession that was supposed to happen in the last 12 months is not going to happen. I think that's been pretty much solidified into the market now. So we're in late cycle stage 3 of the compound landing, which ultimately should end in some sort of material economic slowdown, stage 4. And that driver for that slowdown is not so much a normal credit cycle or just a normal business expansion and deflationary wave. It's really driven by central banks at this point, right? It's if central banks really overstay their welcome any longer in this higher than normal or higher than required restrictive environment, they end up over tightening the economy and really just slowing things down unnecessarily. And I think that's really where we are right now. I'm glad that the ECB and the BOC took action this week. And speaking with the ECB, we went over the BOC, but the ECB, they basically did a hawkish cut. Now, what they did was they basically said that inflation trends are lifting on the longer end, or their outlook on inflation trends are rising, but they still cut rates. And then they implied that they may not see, or they may not see a need for an additional rate cut until the end of the summer. So ideally, there's not going to be a cut at the next meeting. Possibly the meeting after that one, we would see another cut. Now, the reason the ECB has to lay all this groundwork out is the ECB is pretty much the weakest in terms of policy stance out of in this discussion, the Fed, the BOC, and the ECB. The ECB is the one with the lowest rates, right? And the idea always is the Eurozone is a much weaker economy than most of the other economies, right? Because it's a congregation of just all these different sub-economies that could be experiencing different parts of the business cycle all at once. So you kind of get a slosh of just a mess of economic performance. And that's why it's always has been considered a weaker economy, right? So I think that the ECB is in a position now where they should have already cut. I think that they don't want to put the weight on the markets to the point where like the market starts cutting for them aggressively. And they have to put this hawkish fluff into their policy actions to prevent the market's expectations from running away. For example, if we take a look at the ECB forwards right now on they're expecting for interest rate probabilities, we can see that by the end of the year we're looking at another rate cut by the end of the year for the ECB, right? By December. So the next meeting, they're not expected to do anything. The meeting after that, there's talks that they may do something. And then these implieds will change, right? This is how this works. But obviously, these are in basis points. So for every negative 25, that's implying one cut. So by October, the market itself is expecting at least another cut, or pretty much close to it. And by December, we're definitely looking at one more cut this year. And I think that if the ECB was very lax about this and they were just more open, and just saying they're going to cut rates and really not lay that hawkish groundwork or that hawkish fluff, the market would be much lower here. Like I think we would be at a 2 or even 3, well into the 2s, possibly 3 rate cuts going into the end of the year without that hawkish support. And I think that ultimately is what the Fed is going to do too. Like once we see the Fed,
I think the Fed needs to also do that, especially where inflation is. It's still not quite. It's still double the target, right? So they still have some work to do, and they don't want the market to really run with the idea that they're just going to keep cutting and not skip any meetings or anything like that.
Yeah, because what that essentially does is it loosens expectations so far where it then inherently affects financing rates, right? Because then, like, the reason why forward expectations and forward guidance is so important is because the treasury market on a forward basis is going to move on that. If the market prices in 10 rate cuts, right? For example, over the next year and a half, the 2-year treasury is going to inherently pick that up, right? Because the 2-year treasury is a forward-looking metric. It's not the Fed has control over the 2-year, but not as much control, obviously, than like a 3-month bill. So and ultimately the 10-year is really more market floated, right? To some degree outside of QE and whatnot. But the objective here is, and the point is that the Fed needs to control forward expectations, the ECB as well, because if you start letting forward rates, or I should say forward implieds, like the Fed funds futures and whatnot, influence longer term interest rates, then you essentially loosen the economy, right? Because then car loans get cheaper, mortgages get cheaper, right? Even though the Fed only cut once. They
Yeah,
have to
and
prevent.
we saw the effects of that when we had 6 cuts priced in, and we saw what that did to equities.
Yeah, small caps were ripping. Everything was ripping, right? It was 6 rate cuts in 2024. That was like a dream, right?
Yeah,
Obviously, we didn't get that, and we're not going to get that. That was extreme. That was a dream, and that was extreme, right? That was we were saying
it's an
that
extreme
live.
dream.
It was an extreme dream. But interestingly enough, next week we also at the FOMC meeting we're going to have inflation numbers come out. I believe the inflation numbers come out before the meeting, and then but don't quote me on that. We'll have to look that up afterwards. I believe they do, and then we have the FOMC meeting, and I think that the FOMC meeting is going to be a very interesting one, particularly because we're going to get the dots. Now, the dots are going to basically give us some sort of guidance here, where we're going to get to really understand what's going on with the forward expectations within the Fed. And right now we're looking at 3 cuts for 2024. The dots are pricing in 3 cuts for 2024. That can easily change next week. We can get a big update and we could say, okay, they're only picking up 2. That would be in line with what the market's doing. But so the way the market's set up right now, it's quite interesting. The market is quite hawkish because the odds of the Fed pricing in 1 rate, I don't see how the Fed can really come with their dot. I would be very surprised if the Fed shows up with their dot plot implying 1 rate cut this year, because it's not like we haven't seen economic data deteriorate / getting softer, right? However you want to phrase it, it's been weakening, right? So data's been weakening. We're going to get the jobs report tomorrow. That will be a key that will be a key indicator to see where the unemployment stances on unemployment. I suppose we'll probably see the labor market continue to weaken a little bit, but it shouldn't be like real scary. I would be surprised if it's a big jump. It should probably continue to grind higher. That would again support likely that the Fed dots come in at 3. We'll have to see how the unemployment numbers come in tomorrow, though. We'll see when they hit the tape. But ultimately, the Fed's in a position right now where they would have to do a lot to basically hawk out the market. They'd have to do a lot. They'd have to come in with 1. We'd have to go from 3 to 1. So the odds are the market's pretty aligned. The market's pretty aligned here. If anything, the market's kind of hawkish at this point, a little overly hawkish. And we'll have to see what happens. If the dots come in at 3, then the market's going to have to pretty much price in an extra cut. Where we obviously only have 2 right now, 50 basis points by the end of the year from now. And the other thing that happens here, we also have this period where GDP is somewhat weaker, but not really weak. So it's not like it's in real slowdown territory, but it's definitely not. We're not seeing the same GDP prints we were a couple of quarters ago. Like I said earlier, labor's weakening. Job openings continue to eviscerate. Eviscerate's the wrong word, but they continue to basically melt away in the background. No one's really paying attention to those, but they're fading, right? So the labor market is weakening from a behind the scenes stance where the job openings pretty much go first, and then you'll start to see that bleed off into unemployment, and we've been very vocal about that. So I think that at some point we're going to see it really bleed into unemployment, but maybe the Fed can kind of loosen up the conditions before then.
It really feels like we could possibly be entering a positive stock bond correlation to the upside.
Yes, that's actually something that I don't know if we spoke about. We definitely spoke about that on podcast, probably a couple podcasts ago, maybe a month ago, time wise.
Yeah, we touched on it, but we're definitely seeing it more now. Like if you pull up TLT.
Oh yeah.
Like we're almost bullish trend on TLT.
Yeah. So what's going on here is simple, right? If you're going to have the Fed. So if the Fed is not, this is how you have to look at it. If the Fed is restrictive enough, they shouldn't have to cut rates. If they're the only reason they would be cutting rates is they're becoming overly restrictive, right? So if they're becoming overly restrictive and they can realize it somewhat ahead of doomsday, where it's too late, essentially what you do is you just take some pressure off of a steady functioning economy. In that maybe it's semi-weaker under the surface, but it's not really falling apart. So what ends up happening is you take that pressure off that weakening economy with these rate cuts as you do them, and the market can breathe a little bit. Multiples can expand a little bit more, right? Market can breathe a little bit more. Bonds will go with the flow, right? If the market, if the economy is not as strong, getting slowly weaker, the Fed's cutting rates, bonds will get their bid, and both will go up. And then there's typically a juncture at some point where the economy then begins to deteriorate and stocks roll over, and that's when that positive stock bond correlation disconnects, and the bonds will continue to go up and stocks will roll over. And I think that you're right. We could definitely see that positive stock bond correlation run for some time, given that, we still got positive real GDP that's well above 1.5%, 1.8% at the moment, which is like trend. So I think that we're in a good area where the economy can chug along with an adjusting, with a nimble Fed, I should say, and therefore the stock bond correlation can stay positive. Stocks can go higher, but the key there is ultimately those slowdowns are very hard to time. Typically, that's why we have to focus on the underlying data, which is what our system does and our models do. Markets can pull back so essentially what happens is, as growth strength falls, economic implied growth falls, you run into a situation where the market becomes more unsteady. So, for example, in this recent drawdown in April on the Qs, the growth in the system was extremely strong. So it was such an easy fade. This was such an easy fade. Like, this was such an easy buy. And we were pretty adamant. I mean, if you go back on the timeline, we were pretty aggressive in this period, in this drawdown. We were saying like that, the highs were not in. We kept chirping that, and sure enough, they were not. And that's because in drawdowns like this, the bounces are strong because that economic growth is there in the background, and people eventually pick up on it. All it takes is a couple of up days, and everyone's like, oh my God, we're going back to the highs. When that strength weakens and it becomes more questionable, these drawdowns become more elongated and more volatile and more questionable. The recoveries themselves, after these drawdowns. So what happens is now, as growth gets a little softer, if it doesn't really pick up, if it continues to soften, the dips that we may experience may become more questionable. Like this dip that we saw last week, what a recovery that Friday, nice little rally. That's not what I'm talking about. I'm talking about some consistent selling, probably a couple of strings of red days and whatnot, and you'll then know what I mean. Like one down day doesn't count. Ultimately, though, we always have to go back to the foundation, right? So we are still in a risk-on regime. Growth has gotten weaker, but we are in a risk-on regime. Our models have sized accordingly. And because we're in a risk-on regime and the trends are bullish, the base case has to be, the market will continue to go higher. That's the base case. Bullish trend, risk-on regime. Now, if, for example, the regime shifts, then we can slam on the brakes and say, okay. Now we have to reevaluate. But until that happens, it's risk on until it isn't. That's how this works. And you end up you end up avoiding these choppy mental areas where it's like, is it really the time to buy the dip? Is it really the time to sell out of my own total portfolio and go to cash? Our view always is it's risk on until it isn't. If the trend's bullish and you're in a risk on regime, the base case is higher highs. And I think that's where we can wrap up the podcast this week. If you guys have any questions for us, feel free to reach out to us on X at the Market Radar, or go to our website at market-radar.com to learn more about our models and our system. Thank you so much. Have a great weekend.